Welcome to the world of three-way planning. Before we jump into creating your first budget and forecast, let's quickly cover the underlying logic. Three-way planning integrates three key financial statements into a unified planning framework. The profit and loss, which provides insight into the operational performance, the balance sheet, which is a point-in-time snapshot of the long-term financial health, and the cash flow statement, which tracks details on companies' liquidity. Let's break down how they all work together. First up, the profit and loss statement involves planning for revenues and costs over a specific period. For simplicity, let's say your business plans to make $1 million in sales next year, with resulting net profit of $50,000 each month. This net profit will flow to the balance sheet as part of your equity. This will show up under current year earnings or net income as a monthly increase of $50,000, reflecting your cumulative net income or profit. Monthly sales and expenses budgeted will affect your accounts receivable and accounts payable positions on the balance sheet. For example, if you have a 30-day payment terms for invoice sales, the $100,000 budgeted in sales for January will show up in accounts receivable, but only for 30 days. After that, once the payments are received, they clear out and only the new sales remain in the balance. If you're curious to learn more about how to plan for receivables, payables, and inventory, check out our additional video on the topic. Next, you need to plan for other balance sheet positions. The main challenge in projecting the balance sheet is ensuring that the changes in assets and liabilities reflect the plans for profit and loss, and that the accounting equation with assets equal to liabilities and equity holds true. Reach Reporting does that automatically by balancing all budget adjustments on the chosen bank account. Let's say your business takes on $100,000 in debt. This will show as an increase on the bank accounts. Similarly, if you make a purchase of a new asset for $70,000, this will decrease your bank account balance. Now, when cash comes in from your sales or from a loan, or cash goes out for expenses, it's recorded on the cash flow statement. The budgeted net profit or loss will be the starting point for your cash flow calculations. However, the cash flow also adjusts for things like changes in the working capital, including a delay in cash flow for receivables and payables, and changes in fixed assets and long-term debt. For example, the $100,000 loan, shown as an increase in liabilities on the balance sheet, will have an inflow of cash of the same amount under financing activities, increasing your ending cash balance. Similarly, the new asset purchase of $70,000 shows up as a cash outflow under investing activities, reducing your projected cash balance. The ending cash balance will be equal to the bank accounts and undeposited funds budgeted on your balance sheet. By aligning all key financials, the three-way planning helps you forecast future cash flow, plan for funding needs, and decide on growth or cost-saving strategies. That's the basics of three-way financial planning. Ready to dive deeper? Let's move on to creating your budgets and forecasts.